Our latest virtual town hall featured economist from ITR Economics, Ms. Catherine Putney, with a proven prediction accuracy of 94.7%. Harnessing the power of expert economic forecasting, this virtual town hall covers several key insights to help you maximize your financial performance in 2020 and beyond. Key insights covered in our 4-part economic performance series include understanding pertinent data of the current and future economic state, and separating strategic decision-making from our intensely emotional external environment. Identifying key economic indicators to help you prepare, plan, and execute confidently. Segments of construction and development most affected, and ultimately how you can take action now. Part 3 of our economic performance series, ITR economist Catherine Putney reflects on which segments of construction and development are most positively and negatively affected.
So when we do, we are in this crazy environment with the stock market going on, but what we did is we took a look at the past seven relevant precedents when similar movements in the stock market occurred. And we looked at the data and we found that markets rebound for, between 11 and 26 months after. So again, that glimmer of hope that as we do come out of this, we're going to see some really good rebounds in some really high percentage rebounds, 56 to 85% roughly in terms of the performance there. And the length of the rebound, not a determining factor in the magnitude of rise. That's important to know as well. So at the end of the day, what we looked at is the median gain in all of these between that 56 to 85% is 60%. That's a good rebound as we get out of this. So know that we will be back on our feet again, especially for the industries that are more, from an economic terminology, more inelastic. A great example I'd like to use is if your businesses are tied to, let's say, restaurant construction or restaurant activity, when this quarantine comes to an end, I'm not going to go out and double up my restaurant spending when this COVID-19 ends. However, if I'm in the market to buy a house, if I'm in the market to buy something that is more big, let's say a car, that demand's still there. It hasn't gone. It hasn't disappeared. It's not a matter of if, it's a matter of when. I'm just going to wait till September or October to buy a house. So the demand at the end of the day in those inelastic industries, that's going to be a good market for you to penetrate compared to, let's say, the restaurant industry, which they're not going to see as great of a rebound as we come out of this. The restaurant industry may suffer harder because individuals aren't going to go out and double their spend or double their time at restaurants. They're just going to go back to business per usual. So that's a good thing to be aware of as well. All right, let's talk somewhat about your markets. This may be a really relevant part of the presentation today, just because, this is what you're probably going to be feeling day in and day out. So we have a few markets to talk about to say, okay, where are the opportunities? Where are the weaknesses? Where should I be putting eggs into certain baskets as we go through the future? Do I want to be focusing my more sales and marketing efforts in the telecom industry? Do I want to be focusing more in other industries? So we'll get to that right now as we get through today. This is looking at the multi-unit housing market. So you can see housing starts on the multifamily side of things are doing really well right now. They will likely see a tick down or downturn in the near future when we get our hands on more data for, let's say, March and April. But 20.3% starts are growing. That means, we like to track starts because when you have the start, it takes a couple months for all the downstream construction markets to come to fruition. We also like to track permits because you need the permit in your hand before any activity happens with the construction side of things. So that's another market to track. Track business optimism, track permit activity. And we can help you with that if you're interested to get a more specific permit trend to look at for your own market. Now the orange line that we're looking at here is overall vacancies. So what we've seen is lower vacancies point to higher start activity. There's more demand. If vacancies go up, there's no need for more supply. So we have been seeing vacancies generally lower. So that orange line there is inverted. We flipped it over on the scale to the right, as you may notice, because it has that inverse relationship to housing starts. Now, this is on the multifamily side of things. The single family side, as of right now, is doing a similar trajectory, not as aggressive of growth, but still some good growth right now. It may start to temper as we head later into this year, but 2021 is still going to be that good year. So this area will not be impervious to decline, but I think the downturn will be quicker. We're going to come out of this. This is going to be a market that will be hit somewhat, but it's not going to be hit for long before it regains its footing as we head into next year. So track permit activity, track vacancy trends, because that's going to be, at the end of the day, a good indication of new demand rather than existing housing. So track this. This is pointing to good news for overall housing starts on the multifamily side of things. And make sure to understand your positioning in this market. Do you lead it? Do you lag it? When a multi-unit house gets started, do you feel that in your top line data 2 months later, 3 months later, 4 months later? That's something to pick up again too, to make that mental shift when you're looking at the updated figures. Silver lining here, those sinking bond yields that we've been seeing because of the higher demand for the actual bond itself is really helping push down those mortgage rates. We've seen a really great relationship between mortgage rates in orange and overall bond yields in blue there. And there was a funny correlation. I don't have it here today to show, but there is up until Jerome Powell came as the Fed chairman, there was a 100% correlation between the height of each Fed chairman in the direction of the yield. So Jay Powell had to come in and ruin that correlation for us, but we are seeing some really good incentives for the multifamily market and also the single family market if individuals are in the works for buying a new house or investment activity because of the bond yield environment. Now that's if they're prepared. Do they have the cash? Were they hoarding their cash when the economy was good a couple years ago, so they are able to take advantage of this low environment? That's the question. And if you've been following ITR for some time, you would know that we were already calling for this 2019-2020 downturn. Our previous outlook, our previous forecast was still directionally very similar. It just got yanked down a little bit further, more negative because of the COVID-19 situation. Meaning, for those that have been following us for some time, we're already preparing for this slowdown to happen. They were building up their cash reserves. They were implementing the tactics needed to combat this slowdown and make money during the bottom of the cycle. A buy low, sell high mentality. This is what we want to be focusing on. So knowing that we are heading into this downturn, if you're prepared cash-wise, this is when you make your money. All right, opportunities are going to be pretty robust given this downturn that we've been seeing in the healthcare industry. So we have seen historically overall government spending on healthcare, over $1.5 trillion annually. It's not impervious to downturns. You can see it has gone into recession in 08, 09. But that's somewhat of a different story than we're seeing now, because 10 years ago, the 08, 09 downturn was driven by the housing market. There wasn't demand in the healthcare industry. Whereas now, this downturn is driven largely by the illness, the coronavirus that we've been seeing, which could really put extra government spending in the healthcare industry. So know that right now we've seen those opportunities, those threats in the marketplace for certain verticals. We've seen two positive ones so far. We got the multifamily market, especially in a downturn. Going back to the multifamily side of things, I would like to mention that in recessions, individuals, they typically migrate to renting rather than buying. They can't afford the mortgage. They can't, make the payment on their mortgage. They can't qualify for a loan. So they go to renting rather than buying. We saw it in 2008, 2009. So that's a good opportunity to know that the individuals that weren't prepared for this downturn and are being more impacted heavier than others may see that demand and may spur extra activity on the multifamily side of things. And likewise, for opportunities, we're going to see some good opportunities in healthcare. So those are two good markets to be in. What we've covered so far is negative trends going on in oil and gas and anything industrial related right now. Government spending is doing decent and doing well. And then also the multifamily market is doing well as well. So when you're focusing on the verticals you're serving, keep that in the back of your head. You're going to find those are more aggressive opportunities in those more optimistic markets than the oil or gas, and also on top of that, automotive. Automotive I've been tracking that data for years since I've been, essentially from ITR. I've been looking at the trends in automotive, and I think it's a very risky industry. So when we look at automotive, I like to analyze multiple different trends. I look at overall production. I look at inventories, retail sales of automotive. I look at delinquency rates. So those are all meshed together. I'm not looking at one specific trend in itself. And all of those together tell me automotive is going to be really hurting, especially this year, because the industry was already down in the past year. So it's essentially like taking a dog when it's down as we head through a little bit of a more downturn in the economy for the next couple quarters. You could get a 7-year car loan. And if you showed, I heard on the radio, if you go in showing that the pay stub that you make $300 a week, they will give you a $30,000 car loan at 7 years. We're seeing inventories build up. New lots are being built because they can't get the cars off the lots. Production is down. All of those grouped together really tell me we're going to start to see some really heavy negative behavior in automotive. So add that to the list of opportunities that may not be there in the future. Construction, at least for the public water and sewer industry, doing well. We can see some really great trends going on. 12.8% growth for public water and sewer facilities construction. And that's charted over the overall U.S. industrial economy. We can see that the levels of decline typically are more severe in the industrial economy than they are in the public water and sewer facilities construction. Additionally, this is an industry, because it is the public, that gets a lot of investment spent toward during downturns. So we're going to see some really, to stimulate economic growth, there's going to be a lot of spend right now in public water and sewer facilities construction with, updates to the systems, making it more energy efficient. We're going to see some good things coming from the public water and sewer facility side of things. So good industry, add that one to the list of what markets to look at and keep tabs on as we head into the future. Non-residential construction, I had already mentioned, it typically lags the economy. You'll notice that the blue line, which is the U.S. industrial economy, whenever it reaches that low or peak, the orange line doesn't reach that lower peak, which is construction, until later. And that's why I mentioned that construction right now on the non-res side of things is doing well, because last year was good in the economy. So that's benefiting, non-res construction is benefiting now. So we're seeing it will still be in a general slowdown as we head into next year, but right now it's doing really well. And there are certain pockets within non-residential construction that are faring better than others. It depends on the way you look at it as well. Office construction, somewhat negative impact from the substitution to working from home and working remotely. But on the other hand of things, the dollar amount of office construction is doing well because the offices that are being built are the luxury offices. So when we look at this data, it is measured in dollars. So it is subject to the pricing aspect of it. So in terms of volume, it may not be there, but the pricing point may be there. So volume may not see as many opportunities in terms of new offices, but the value of those offices are going to go up. So this may be a pocket of opportunity to focus on those high-end types of of marketing and sales tactics to grab the market share in the luxury aspect of overall office. Warehouses are also doing really well right now because of the e-commerce effect. I like to call it the Amazon effect. 5-10 years ago, you had the warehouses, one or two here and there in the Midwest, and to get it from the warehouse to your front porch, it took a lot longer than it is right now. So the competition of trying to get that quick, 1-day shipping turnaround is stimulating growth in warehouses all over the U.S. So it's not just in the Midwest anymore where we're having these warehouses where the products are being manufactured. They're all over the place because they want that turnaround to be as quick as possible in shipping. The warehouse is a really good area of opportunity as well. Telecommunications services revenue. So this one is doing, it's in a slowdown. You'll notice that up the top there, we have 1.6% growth, so still positive. But I think this is going to be a really great industry to be in, given not only this COVID-19 situation really trying to, or really increasing the bandwidth needed in the overall market. This is going to somewhat shift the whole perception of working remotely. I think a lot of businesses are finding that it's working, at least the businesses that are not boots on the ground, that are the businesses that are out there, doing service industry or service types of products. What we're seeing there is this is going to be a whole new economy after this COVID-19. A lot of businesses are going to learn from this. And telecommunications is going to be able to reap the benefits of the fact that there's likely going to be more people working remotely. So not only is it benefiting now, but I think that the whole structure of working remotely is going to change the way business is done into the future.
Thank you for watching. You can find more information at www.csdz.com and click on our COVID-19 Keeping You Informed tab. Or to speak with a CSDZ construction expert, you can reach us at construction@csdz.com. CSDZ, your risk rewarded.